This is Matthew Cratter from Trader University, and today I want to talk about the Nasdaq whale. In other words, the really big trader who's been moving the stock market. If you're interested in learning how the stock market and the economy actually work so you can make money in bull or bear markets, or you just want to see what I'm trading or investing in, be sure to hit that subscribe button. So we've obviously been having some really big up moves and down moves in the stock market, and I think there is a major factor behind it besides just the central bank money printing, which we've been talking about. And that major factor, as we're just learning yesterday, is SoftBank. Now, SoftBank, very familiar name. They were obviously big investors in WeWork and also in Uber, had a very bad 2019. But it now turns out that they've become sort of like Robin Hood traders, I guess would be the analogy, that they've been buying huge amounts of call options. And this is an article in the Financial Times that just came out yesterday saying that SoftBank is the Nasdaq whale. In other words, the big trader that's been buying billions of dollars worth of equity derivatives. In other words, call options. Now we're going to talk about how this can exacerbate market moves. But this was interesting that one person familiar with SoftBank's trades said it was gobbling up options on a scale that was even making some people within the organization nervous. So what they've been doing is it looks like they've been buying tech stocks at least since the spring, $4 billion worth of shares of Amazon, Microsoft, Netflix, plus Tesla. And now it turns out also that they have been buying billions of dollars worth of options as well, especially call options. And I want to show you why this can make the stock market go up when someone comes in and just starts buying a lot of call options. So let's say I buy a call option. Now, call option is a bet that a stock is going to move higher. If I buy a call option, there has to be someone on the other side, and it's often a hedge fund or a market maker or some trading firm. We'll just call it an options market maker. If I buy a call option, because these are zero-sum games, to create a call option, someone has to go long, someone has to go short. So if I buy one call option, an options market maker has to sell me one call option. Now, if you are selling me a call option, that means you are short one call option. Now, in practice, these options market makers will have huge books of options that they'll be hedging and managing. So I'm giving you a very simple example here, but it also works at the aggregate level. If an options market maker sells me one call option, they now have unlimited risk if the stock goes up because they're short a call option. And so what they'll frequently do is they'll either offlay the risk or they will hedge it using the underlying stock. So in this case, if it's an at-the-money call that I bought, we know that almost by definition, an at-the-money call has a delta of 0.5. What this means is if the stock goes up $1, an at-the-money call option will make 50 cents. I talk more about this in my options trading course. But let's say that I buy one call option. Each call option has the equivalent, has sort of a notional value of 100 shares of stock. And so the way you delta hedge is you basically take the number of shares of stock per contract times the number of contracts times the delta, and that tells you how many shares you need to use to delta hedge your position. In other words, to make it neutral if the stock goes up, so you don't have this sort of open fat tail risk on your book. So I buy a call option, market maker sells me that call option, and then he buys 50 shares of stock to delta hedge his position. You can sort of see where this is heading. Now what happens is delta hedging is a dynamic form of hedging. As the stock moves around, you will buy or sell shares if you're hedging a book of options. In other words, maybe you have options, you're either long or short call options in the S&P, and the Nasdaq 100, and Tesla, and Amazon, etc. In this example, again, we're just using a single stock. But let's say the stock rallies after we enter this transaction. As the stock goes up, its delta is going to increase. Deltas they go up when the call option goes up. And so let's say the stock is rallied and now the new delta is 0.75 or 75%. In practice, they will hedge along the way, but I'm just using sort of big round numbers here. In that case, the new delta of the position of the short call position is 100 shares times one call option times 0.75. So this options market maker now needs to be long 75 shares of stock to hedge his position. Now we know he was long 50 shares of stock. This means that because the stock has moved up, he has to buy more shares of stock to hedge his position. So you have this weird situation, this weird positive feedback loop where the more the stock goes up, the more shares of stock the market makers need to buy to stay delta neutral. And again, the more shares of stock they buy to stay delta neutral, the more it drives up the stock. And so you can have these crazy moves like we've seen. They've obviously been exacerbated by retail traders, maybe Robinhood traders, and sort of a lot of people trying to play the splits and Tesla and Apple. But there's also been a very strange scenario where while these stocks have rallied, the VIX has also been moving up. This is unusual. If we scroll out, we can see normally over the past 10 years, when stocks rally, the VIX goes down. It gets down to a very low level. It even was below 10 a couple years ago. But this has been a really weird year. As everyone knows, 2020 is a strange time. There's obviously a lot of uncertainty surrounding the election, which may or may not be justified. But the VIX has really stayed above 20 during this whole rally. And then late in August, we saw something very strange, where as the S&P was hitting new highs, the VIX started to move up. Now, the VIX is a measure of implied volatility. It's a measure of people not just buying put options, but also buying call options. If a lot of people, like Robinhood traders or a big trader with a lot of money like SoftBank, buys a lot of call options, what will happen is, because of something called put-call parity, where puts and calls have to stay balanced, even buying call options will drive up the VIX. And I believe that's what we've been seeing. And we got a hint of it on August 31st when the VIX started to move up, even as the stock market. So the stock market peaked a couple days later on September 2nd, but the VIX was moving up along with stocks. This is very unusual. Something I do talk about volatility skew in my momentum stocks course, which you can check that out. I go into a lot of detail about these dynamics, but all you need to know here is that SoftBank may be behind this really weird feedback loop where they buy call options on tech stocks. This means that market makers have to buy more shares of the underlying, and the more that everyone buys, the more the stock goes up, and you end up with these situations where the stock really melts up in a way that's not sustainable, and then you begin to hit an air pocket. We had a warning of that on Thursday with Peloton. I talked about the hanging man, and that turned out to be really what happened. We got this terrible reversal in tech stocks, and we'll see how this plays out. September is normally a very negative time of year, but it does look like that SoftBank, maybe they top ticked this one, maybe they were buying at the peak, and who knows what happens with them, whether they have to reverse these positions. It actually looks like from reading this article that what they've done is they've, in a lot of these positions, they've bought a call option. Maybe they buy a call option at the money somewhere here, and then they sell a call option, doing sort of a call spread. So they're betting on capturing this amount of time. So this amount of movement. But either way, I think this does explain the really weird phenomenon we saw where implied volatility was moving up at the same time as stocks. You don't see that very often. The last time I saw it really was in the late 90s with the dot-com melt up. So we'll see. I think this could possibly be a rough September. It's normally a rough time. But whatever happens, the central bank does have the markets back. The central bank needs to print more money and needs to continue to prop up all the financial markets by buying junk bonds, etc., especially going into this election. So any dip, we could certainly go down 10, 15% from here. I have no expectation whatsoever that we'll see any sort of crash like we saw in March. The Fed has totally changed everything. They've made it very clear that they won't tolerate a stock market crash. They can print money and they can prop up the market. They can prop it up indirectly by buying junk bonds or buying other kinds of bonds. They're not technically allowed to buy stocks, but as you have seen in some of my previous videos, the Fed has been behind buying stock index futures in the past, even in the late 1990s. If you found this video helpful, make sure you hit that subscribe and like button. Let me know your questions and comments in the comment section below. And thanks a lot for listening. Hope you guys have a good weekend.